At different times in history, the notion of progress has always occupied a central place in the collective imagination. The idea that the future is inevitably better than the past has become almost a dogma. Technological advances, economic growth, and social transformations reinforce this perception. However, when it comes to the real lives of ordinary people, especially those at the base and center of the economic pyramid, the answer is not so simple. Is living in 2025 really better than living in 1955? This is not just a question of nostalgia or generational comparison. It is a deep investigation into how prosperity is distributed over time, who really benefits from growth, and which promises have been fulfilled or betrayed. Comparisons between eras cannot be made based solely on assumptions or memories. They require data, context, and, above all, a careful look at what doesn't usually make the headlines. There are charts that clearly show that the economy has grown exponentially over the past 7 decades. Adjusting for inflation and population growth, the numbers indicate a significant increase in so-called national prosperity. But the size of the economy does not, by itself, tell us who is benefiting from it. The mere existence of a big pie does not guarantee that everyone will have access to a fair share. Growth is one thing. Distributing that growth equitably is quite another. The aim here is to explore how this prosperity was, or was not, shared among ordinary citizens. The focus will be on the trajectory of those who occupy the center of society, middle-income workers. They are the ones who, in theory, most closely resemble the portrait of the average citizen and whose experiences help us understand the true state of a nation's economic health. Through 4 fundamental pillars: income, housing, wealth distribution, and social mobility, it will be possible to draw a consistent panorama of the evolution or regression of these conditions over the decades. To understand the situation clearly, we need to abandon the idea that time alone guarantees improvement. Moving forward does not always represent progress. The data shows that there were periods in which progress was widely shared, and others in which it was increasingly concentrated in the hands of a few. Assessing who had the best life requires going beyond consumer goods, technological innovations, or new lifestyles. It involves investigating whether the average citizen actually had more chances to live with economic security, stability, and prospects for advancement. Rather than making statements or speculating, the proposal is to examine how the country's economic performance has translated, or not, into quality of life for the majority. This is where the essence of the question lies. If the country has become richer, but the income of the majority has stagnated, there is something relevant to be discussed. If owning a home, which was previously attainable with just a few years of work, is now a distant project even for those with a good income, this is a structural change that cannot be ignored. If productivity growth has not kept pace with wage growth, then effort is not being rewarded as it once was. And if the likelihood of a person having a better life than their parents has decreased, something essential to the so-called American dream has also diminished. It's about understanding whether the system is working for everyone or whether it has been adjusted to benefit only a portion of the population. And more than that, it's about reflecting on the extent to which the idea of social mobility, central to so many modern democracies, remains viable. The world has changed, but not all changes represent progress for everyone. Some increase inequalities, while others reinforce historical privileges. And while public policies, the labor market, and the cost of living change, ordinary citizens need to adapt, not always with the same opportunities that existed in other times. This portrait that will be drawn over time is not limited to the accumulation of facts or figures. It is an attempt to reveal hidden patterns beneath the surface of the data. It is not enough to note that the economy grew. It is necessary to ask who, exactly, rose with it, and who was left behind. Because what is at stake here is not just the comparison between 2 dates, but a deeper understanding of what it means to live well in a country that prides itself on its growth, but does not always guarantee that this growth translates into collective well-being. The United States' economic growth over the past 7 decades is undeniable. Since the post-war period, the country has experienced rapid growth in production, consumption, and wealth accumulation. Between 1950 and 2020, per capita, GDP more than tripled, even after adjusting for inflation and population growth. This leap represents an impressive gain in productive capacity, driven by innovation, industrialization, urbanization, and, later, by advances in digital technology. On paper, everything points to significant progress. But the crucial point is not just the amount of wealth generated, but who actually had access to this prosperity. In the 1950s, the American economy was experiencing a period of optimism and expansion. The end of World War II had left the United States as the largest industrial power on the planet. With Europe and Japan rebuilding, global demand for American products soared. Mass production found ready and confident consumers, and the government acted decisively to foster this cycle. Programs such as the GI Bill, aimed at veterans, facilitated access to higher education and homeownership. The average salary of an industrial worker allowed a family to be supported with just one source of income, something unthinkable in many current realities. In addition to the creation of stable jobs, the period was marked by a notable convergence between productivity growth and wage increases. Workers became more productive and, at the same time, saw their incomes increase proportionally. The result was a society in which a large part of the population perceived real gains in their quality of life as the country grew economically. Consumption increased, but so did financial security, access to durable goods, and, in many cases, the building of wealth. In the 1960s and 1970s, growth remained positive, albeit with fluctuations. Oil crises, international tensions, and changes in the global market began to put pressure on the stability achieved in the post-war period. Even so, the incomes of most workers still kept pace with national gains with some regularity. During these decades, growth still translated into tangible improvements for millions of families. Purchasing power remained relatively stable, and the promise of progress seemed largely within reach. But this dynamic began to change profoundly in the 1980s. It was in this decade that the first clear signs of a disconnect between economic growth and middle-class gains emerged. Political and economic reforms, such as deregulation of sectors, tax cuts for the wealthy, and the weakening of unions, changed the gears of the system. The economy continued to grow, and significantly. However, the pace of growth in average income began to slow, while gains at the top of the pyramid began to expand at an ever-increasing speed. This new cycle ushered in a phase marked by a more intense concentration of prosperity. Companies became more profitable, financial assets appreciated rapidly, and new technologies increased productive efficiency. However, workers' pay failed to keep up with this progress. Productivity per worker in the United States nearly doubled between 1980 and 2020. However, average real wages remained stagnant for long periods. This indicates that, although the capacity to generate wealth has grown, the distribution of this wealth has become increasingly unequal. While executives at large corporations saw their pay increase tens or hundreds of times, mid-level workers faced wage freezes, loss of benefits, and job insecurity. In 1980, the difference between what a CEO earned and an average worker was about 30 times. By 2020, that number had surpassed 350 times, revealing a disparity that has only widened. Economic growth no longer automatically equates to better lives for most people. This phenomenon is not limited to wage differences. It directly affects access to opportunities. When economic growth is concentrated in the hands of a minority, the possibilities of investing in health, education, housing, and security for the majority of the population are compromised. The wealth accumulated at the top tends to generate more wealth for those who already have it through investments, inheritances, and political influence. Meanwhile, those who depend on work for a living face greater difficulties in accumulating capital and improving their position throughout their lives. The American economy continued its upward trajectory over the following decades, driven by globalization, digital innovation, and new business models. But the gap between macroeconomic growth and the reality experienced by much of the population became increasingly evident. The data show that absolute economic growth alone does not guarantee an increase in the standard of living for the majority. How the fruits of this growth are distributed determines the real impact on people's daily lives. Over the years, the discourse of continuous progress has come to coexist with clear signs of stagnation among those who depend most on the labor market. The economy is booming, but the average citizen often remains in the same place, facing higher costs, stagnant wages, and increasing barriers to improving their lives. Understanding this contradiction is essential to assessing whether the economic growth of recent decades, despite being robust, has truly been a collective benefit or whether it has become a privilege for the few. When it comes to quality of life and economic security, few elements are as central as housing. Owning a home goes far beyond having a roof over your head. It means stability, security, and, most importantly, building wealth. It is through housing that most families consolidate wealth over the course of their lives. It represents an asset that can increase in value, serve as collateral, and be transferred between generations. Therefore, observing how access to housing has evolved over time is essential to understanding the most profound transformations in a country's social and economic structure. In the 1950s, the American scenario strongly favored the acquisition of real estate by the middle class. With public policies aimed at encouraging home ownership, affordable interest rates, and subsidized financing programs, purchasing a home was an achievable goal for most families. The costs were compatible with annual income, and the time needed to pay off a property was relatively short. A single source of income was often enough to cover household expenses, support the family, and still invest in the purchase of the property. This context allowed not only to live with dignity, but also to build a stable wealth over the years. Furthermore, the growth of suburbs and metropolitan areas contributed to the expansion of this model. Cities expanded horizontally, and new residential neighborhoods became symbols of the so-called American dream. A house with a yard, garage, and quiet neighborhood began to represent not only comfort, but also success and social belonging. For many, it was a clear sign that the effort had been worth it. However, this pattern of access was not universal. During this same period, millions of Americans were systematically excluded from these benefits by discriminatory policies, such as redlining, which limited housing finance to Black people in many areas. Even with the same financial qualifications, many families were prevented from buying homes in certain neighborhoods or from obtaining credit on fair terms. This created a historic wealth gap, the effects of which are still felt today. In the 1970s, the average cost of a home began to rise more sharply. It was still possible to purchase properties with financing, but the macroeconomic scenario began to make access difficult. High inflation, oil shocks, and the aggressive monetary policy of central banks led to higher interest rates, making mortgage loans more expensive. At the same time, the general cost of living increased, making household budgets tighter. Even so, home ownership remained within reach of most middle-income populations, although it required more effort than in previous decades. The most significant change occurred in the 1980s. The economic transformations of the time had a direct impact on the real estate market. The deregulation of financial sectors created new financing models, but also increased speculation. The appreciation of real estate values began to be seen as a profitable form of investment, attracting capital and putting pressure on prices. At the same time, the stagnation of average wages reduced families' purchasing power, creating a gap between what real estate costs and what they could afford. This dynamic became more pronounced in the following decades. Between the 1990s and 2000s, real estate began to represent an increasingly larger part of family budgets. In many cases, the value of an average home became equivalent to 3 or 4 times the annual income of a typical household. And although credit became more accessible in terms of requirements, it came with risks. The most obvious case was the 2008 crisis, when a real estate bubble burst and millions of people lost their homes. The financing system, encouraged by financial institutions, had granted credit to those who could not actually pay, generating a chain of defaults and a global financial collapse. After this collapse, real estate prices fell for a while, which provided a brief relief in housing affordability. But the market recovery was accompanied by a new rise in prices, especially in large cities. From the 2010s onwards, it became common for even well-educated professionals with a stable income to have difficulty purchasing a property in the areas where they live and work. Rent began to consume a larger share of the budget, making it more difficult to save for a mortgage. At the same time, competition from institutional investors, who began buying properties on a large scale, further reduced the supply for individual buyers. The result was the consolidation of a scenario in which housing ceased to be merely a right or a basic necessity and began to behave as an asset of high speculative value. Access to property, previously seen as a natural stage of adulthood, became a growing challenge, especially for younger people. Many began to postpone or abandon the idea of owning their own home, which represents a significant change in relation to the historical pattern of previous generations. The difficulty of buying a property does not only affect comfort or stability, it directly compromises the possibility of building wealth. Without the appreciation of one's own property, families depend exclusively on income from work to maintain their economic position. And since average wages do not keep up with the pace of property appreciation, the gap between those who have assets and those who do not is rapidly widening. Owning or not owning a property becomes one of the main dividers in the economic trajectory of individuals with similar conditions. This process generates intergenerational impacts. Families who own property are able to transmit economic security to their children. Those who are unable to enter the real estate market remain in more vulnerable cycles, with less investment capacity, less stability, and greater exposure to market fluctuations. Property, which was once a symbol of stability and advancement, has become a marker of inequality. The ability to acquire a home does not depend solely on individual effort, but increasingly on inheritance, family support, or capital accumulated over previous generations. The deepening inequality in access to housing, as we have seen previously, did not occur in isolation. It is part of a broader phenomenon with deep structural roots. The progressive concentration of wealth in the hands of a minority, while the majority of the population faces increasing limitations in accumulating capital. This distortion is not limited to the present. It has consolidated itself over the decades, gaining strength in certain periods and altering the basis of income distribution and opportunities in the country. During the decades following World War II, American society experienced one of the most equitable periods in its recent history. Economic growth was accompanied by a relatively even distribution of income. Workers in different income brackets saw their incomes increase proportionally, creating an environment of shared prosperity. Taxation on the wealthy was high, unions were strong, and the government played an active role in building infrastructure and public services. This balance, however, began to unravel in the 1980s. Tax reforms, cuts in social programs, and an economic policy focused on liberalizing markets changed the functioning of the system. Taxes on the highest income brackets were significantly reduced, while redistribution mechanisms were weakened. At the same time, the wages of most workers began to grow at a much slower rate than productivity and corporate profits. The direct consequence was the emergence of a new phase, the growth of disparities. Data from the Organization for Economic Cooperation and Development, OECD, indicate that the United States has become one of the advanced economies with the highest level of income inequality. While the richest 1% accumulated increasing earnings from investments, dividends, and million-dollar remunerations, the middle class saw its purchasing power stagnate. The gap between the average income of the richest and poorest families increased year after year, reflecting a growth model that favored those who already had capital. This reality becomes even more evident when we look at the distribution of net wealth, that is, the total wealth of families. According to data from the Federal Reserve, The richest 10% of the American population now holds more than 70% of the country's total wealth. This includes real estate, stocks, investment funds, and other assets that appreciate over time. In contrast, the poorest half of the population has, on average, close to zero wealth when they're not in debt. This means that, even though they work full-time, many people are unable to save or invest, leaving them vulnerable to any economic crisis. This wealth inequality is reinforced by two factors. First, the difference in the type of income that each group receives. While the richest earn a significant portion of their income from capital gains, the rest depend exclusively on wages. Second, the logic of the tax system itself, which taxes income from work more highly than financial gains. Thus, those who live off investments can pay proportionally less tax than those who depend on their wages to survive. This widens the gap between those who accumulate and those who merely cover their basic expenses. Another important aspect is the exponential growth in the compensation of top executives. Companies listed on stock exchanges began to link the earnings of their executives to the performance of their shares. This created incentives to increase short-term profits, often at the expense of wage restraint or the reduction of benefits for other employees. The result is an increasingly wide disparity within corporations themselves. In the 1960s and 1970s, a CEO received, on average, 20 to 30 times more than a regular worker. In recent decades, this difference has jumped to hundreds of times, highlighting a gap that goes beyond economic results and also affects the perception of social justice. Inequality is not limited to income and assets. It also manifests itself in the way people access essential services. Quality education, healthcare, security, and transportation are often dependent on the ability to pay. Wealthier regions have well-equipped schools and modern hospitals, while poorer areas face structural precariousness. This segmentation creates a cycle that is difficult to break. Families with fewer resources face more obstacles to improving their conditions, while those with accumulated advantages are able to reproduce them over generations. Economic advancement, once associated with individual effort and merit, has become increasingly dependent on starting point. Children from wealthy families have greater access to higher education, experiences abroad, networks of contacts, and opportunities for well-paid work. Those born into vulnerable contexts face difficulties from an early age, from schools with poorer infrastructure to the lack of food security. Economic inequality, in this sense, becomes inequality in life prospects. This is where the distribution of wealth reveals its true impact on society. More than a statistical issue, it directly affects the social fabric, fueling tensions, insecurity, and the perception that the system is out of balance. Social mobility, which for decades was associated with the ideal of personal growth, becomes increasingly limited. The future ceases to look promising when effort does not result in progress. And in this context, the role of public policies, fair taxation, and collective investment becomes crucial to restore some form of balance. Extreme concentration of income and wealth is not inevitable. It is the result of choices made over time. Tax rules, labor structures, access to credit, and market regulation shape the way wealth circulates. When these decisions disproportionately favor a minority, economic growth loses its power as a tool for inclusion. The result is a system that accumulates resources at one pole while increasing scarcity at the other. An economy like this may grow, but it does not advance as a society. When inequality is persistently established, its effects are not limited to the present. They shape what is possible in the future. And it is precisely at this point that the idea of social mobility begins to weaken. The belief that anyone can improve their lives through effort, dedication, and individual merit has always been a symbolic foundation of American society. However, this promise has become increasingly difficult to fulfill for a significant portion of the population. For much of the 20th century, upward mobility seemed like a viable path for millions of workers. Children of blue-collar workers were able to achieve higher levels of income, education, and economic security than their parents. This was possible because of a combination of favorable factors: shared economic growth, increased access to higher education, stability in the labor market, and public policies that promoted inclusion. The distance between the starting point and the destination point was surmountable, which fueled the expectation of continued personal advancement. However, in recent decades, this social ladder has become steeper. The foundations that supported this ascension have weakened. The job market has become more volatile. Average incomes have lost momentum, and education and healthcare costs have soared. The result is that, even with academic training and professional dedication, many individuals encounter structural barriers that limit their advancement. The idea that effort alone is enough to achieve a better life is no longer supported by the data. Research on intergenerational mobility suggests that in the United States, the likelihood of a child from a middle-class family earning more than their parents has been steadily declining since the 1970s. According to studies by economist Raj Chetty's team, those born in 1940 had about a 90% chance of exceeding their parents' income. For those born in 1980, that number has fallen to about 50%. This decline represents more than an economic shift. It symbolizes the erosion of one of the central promises of the American social project. When analyzing the trajectory of the different income brackets, it is observed that rigidity has increased, especially at the extremes. The richest maintain their positions with greater ease, while the poorest face persistent obstacles to climbing the social ladder. This creates an environment in which place of birth, initial family income, and parents' educational level become almost absolute determinants of economic destiny. Stories of overcoming obstacles become exceptions, and no longer the reflection of a functioning system. This hardening of mobility is also related to the unequal distribution of opportunities. Access to quality schools, extracurricular activities, paid internships, and environments that encourage intellectual development varies greatly between neighborhoods and regions. Children who grow up in underprivileged communities often face limitations from an early age. Educational gaps, lack of support, and exposure to violence compromise the full development of their capabilities. Thus, competition for places in universities and skilled jobs starts from extremely unequal starting points. Higher education, once a key tool for breaking cycles of poverty, has become unaffordable for many. Tuition fees have risen sharply in recent decades, and student debt has reached historic levels. Even those who do manage to complete college do not always find jobs that match their education. The market is absorbing qualified professionals with lower than expected salaries, while the cost of living continues to rise. This generates frustration and instability, especially among the younger generations. Another fundamental variable in this scenario is inheritance. The ability to pass on wealth between generations has become one of the biggest differentiating factors. Families that accumulate real estate, investments, and financial assets guarantee their children a significant advantage. This is reflected in access to paid courses, international travel, capital to start businesses, and, most importantly, the peace of mind of taking risks without the fear of irreversible failure. On the other hand, young people who grow up in families without wealth face permanent uncertainty. Any mistake can jeopardize years of effort. This cycle silently perpetuates itself. It is not just about inequality of income or access to material goods. It is a model in which the point of origin shapes the path, restricting choices and limiting possibilities. The psychological impact is also relevant. When individual effort does not generate visible returns, discouragement sets in. The feeling of powerlessness in the face of a system that seems to reward only those who already have privileges erodes collective trust and undermines the sense of justice. In an environment of limited mobility, the promises of meritocracy ring hollow. The narrative that everyone has the same chance ignores the real starting conditions. Competition takes place on uneven ground, and the outcome can hardly be considered fair. Accumulated frustration turns, over time, into distrust in institutions, political polarization, and withdrawal from civic participation. The idea of a society where talent and effort define the future becomes distant from reality, replaced by a model in which destiny seems predetermined. By observing this movement, it is possible to understand why the American dream, once so present in the collective imagination, has lost its symbolic power, not for lack of ambition or will to succeed, but because the conditions that sustain this dream no longer exist for many. The combination of growing inequality, limited access to opportunities, and social rigidity paints a picture in which mobility is no longer the rule but the exception. And when a society is unable to offer real opportunities for advancement to its citizens, its cohesion begins to weaken. Over the past few decades, the portrait of the middle class in the United States has undergone profound transformations. What was once synonymous with stability, advancement, and security has become marked by uncertainty, financial pressure, and reduced expectations. The combination of sustained economic growth and unequal distribution of wealth has altered the logic that has long underpinned the balance between effort and reward. An analysis of the most relevant indicators reveals a consistent pattern. The economy has expanded its productive capacity, but the gains generated by this advance have not been distributed proportionally. While the upper echelons of the pyramid have increased their control over capital, the base of the population has faced wage stagnation, difficulty in accessing housing, growing debt, and an environment hostile to mobility. These factors combined have reshaped the middle class, reducing its room for maneuver and undermining part of its historical role as an axis of stability and growth. The cost of living with dignity has increased significantly. Items that were once considered basic, such as quality education, health insurance, safe housing, and retirement, have begun to require ever greater efforts. Many families live in a constant state of financial vigilance, trying to balance tight budgets in a scenario where unexpected events are increasingly expensive. The feeling that work no longer guarantees progress has spread, affecting not only the pocketbook, but also the sense of belonging and optimism about the future. Behind the numbers, there is a silent reality. People who dedicate themselves daily, who seek qualification, who make conscious choices, but who find themselves limited by a system that no longer responds in the same way to individual commitment. The value of effort remains, but the return has become uncertain. And this frustration is not a one-off. It has been repeated from generation to generation, fueling a growing distrust of the promise that the next stage will be better than the last. However, this is not an immutable condition. The decisions that shaped this reality were political, economic, and institutional. And different choices produce different results. The way a society distributes its resources, organizes its labor market, and structures its public policies defines the kind of future it builds. The decline in social mobility and the weakening of the middle class are not natural events. They are consequences of decades of economic direction that favored concentration over sharing. If current signs indicate that a model is exhausted, this also opens the door to profound revisions. A healthy economy is not sustained solely by accumulation at the top. It depends on the vitality of its base, the capacity for renewal of its middle class, and the confidence that the effort is still worthwhile. Reversing the trend of stagnation requires more than growth. It requires political will, a redefinition of priorities, and, above all, a commitment to equity. Recent economic history shows that progress is not guaranteed. It needs to be built continuously, with choices that expand opportunities and strengthen social bonds. If the middle class was once the engine of economic expansion and collective well-being, it can play that role again. But this depends on reestablishing the conditions that allow people to dream, plan, and achieve their goals without the starting point determining the destination. Ultimately, the true portrait of a country is not only in the numbers it produces, but in the quality of life it offers to those who build it every day. A society is fairer when those who work, contribute, and participate have a real chance to advance. And when this chance becomes a privilege for a few, something essential is lost. Because the progress of a nation is not measured only by how much it grows, but by how many people are able to grow along with it.